Ever heard someone say they're investing in bonds and wondered what that even means? Or maybe you've seen US Treasury bonds pop up in the news whenever the economy gets shaky. Well, let's break it down simply, clearly, and in plain English. This is your crash course on US bonds, what they are, how they work, and why they should matter to you. Let's start with the basics. A bond is basically a loan, but you're the one doing the lending. When you buy a US bond, you're actually loaning money to the US government. In return, they promise to pay you back plus interest after a certain period of time. Think of it like this: the government needs funds for things like roads, schools, and defense. Rather than raising taxes, they borrow that money. You give them the cash now by buying a bond, and in return, you get a small profit over time. That's your interest. There are a few main types of US bonds you'll hear about. First, Treasury bills, or T-bills, are short-term, maturing in less than a year. Then we have Treasury notes, T-notes, which run from 2 to 10 years. And finally, Treasury bonds, T-bonds, long-term, up to 30 years. Each type pays interest a bit differently and is designed for different needs. So, why should you care about bonds at all? Simple. Bonds are known for being safe investments. While stocks can be wild and unpredictable, US government bonds are backed by the full faith and credit of the US government. That's about as secure as it gets. In the world of investing, there's always a trade-off. The more risk you take, the more reward you might get. Bonds sit right in the middle, offering more than a savings account, but with less risk than stocks. Here's a quick example. If you put $1,000 into a 10-year Treasury note at 3% interest, you'll get $30 a year in interest, guaranteed. After 10 years, you get your $1,000 back, plus $300 in total interest. It's simple, predictable, and pretty low stress. Now, how do you actually buy US bonds? You don't need a broker or some fancy app. Just head to treasurydirect.gov, the government's official site. You can buy, hold, and manage your bonds directly, with no middleman. It's secure, paperless, and open 24/7. Like everything in finance, bonds have their pros and cons. The pros: they're safe, stable, offer predictable income, and help balance your investment mix. The cons: returns are lower compared to stocks, inflation can chip away at your profits, and you might be locked in for a while. Bonds are especially popular for retirement planning. When you're older, protecting what you've earned is often more important than chasing big gains. Bonds give you peace of mind and a steady income. So, whether you're just starting out or planning for retirement, US bonds can play a key role in your financial future. They're not flashy, but they're foundational. If you found this breakdown helpful, smash that like button, subscribe for more no-fluff financial content, and comment below, have you ever invested in a bond? I'd love to hear your thoughts. Invest smart, live free, subscribe today.